Hello, and welcome back to the Profitable Rental Podcast by Landlord Studio. Again, I'm Logan Ransley, the co-founder of Landlord Studio, a property management and accounting software designed for small to medium-sized portfolio landlords. In this podcast, we explore the 6 building blocks of real estate profitability and success with industry experts to help you build a profitable and scalable rental portfolio. Today's episode is the second of a 2-part series with 2 very special guests. This week's episode explores practical advice for managing your real estate finances and scaling your portfolio. Let's jump back into it. You mentioned previously, Sharon, about loan to value ratio. I'd love to know a little bit more about that. It could be quite a technical term for somebody who's not familiar, but why don't you just explain that really quickly and give some reasons of why that's important when you are starting to dive into this whole real estate investment journey.
The commercial property I was talking about, we had there was a provision in the mortgage that had a loan to value provision that it was, I can't even remember now what it was, maybe 80% or not 70%. The loan couldn't be more than 70% of the value of the property. So when we bought the property, it was valued at about 10 million and the loan was 5 million. So we were well within that. I mean, that was never even a thought process that we needed to even consider. And then in 2007, 2008, that property dropped in value dramatically to the point where we had a $4 million loan at that time, and the property value was $5 million. So we violated the loan to value covenant, and then we lost our tenant. And so it's one of those things that you just have to pay attention to. And when you have the right accountants and tax people on your side, they help you keep an eye on that kind of thing, but you need to be aware of it. I have a dear friend who almost got thrown into bankruptcy. She never missed a payment. She had a large building, was never in arrears. She was actually the bank's PR partner, right? She was doing commercials for the bank, and she had this large property, and she ended up having a problem with loan to value on the property, and they almost forced her into bankruptcy, and she never missed a payment. And so that's the kind of thing where but it's what's in the contract. So you got to understand what the contract says and make sure you stay within that property. Same thing with some home mortgages, right? You want to make sure. I tell people when they have an investment, pay attention to your numbers. You got to know your numbers. And as long as you got positive cash flow, you may be upset that $200,000 house dropped to $150,000. But if you're still positive cash flow and you're not having a problem with the bank, you only have a problem with that value if you sell, right? Let's make your profit on the buy of the property, making sure that the cash flow every month is more than what your expenses are, so that has a positive cash flow for you. And then eventually that property will hopefully continue to appreciate and go up. But there are always corrections in value, but you only lose money when you sell it, if it's below what you bought it for.
And I guess the loan to value kind of guidelines or best practices, what are you kind of, I guess a question for you, Brandon, how are you kind of advising clients around this? Like from your perspective, what are some of those guidelines that you're advising clients when they're starting to get into that?
We don't really, because we've learned that everybody has a differing degree of risk that they are willing to take on. So we'll kind of like ask questions to get them to think about it. But we're not going to say you need to have 30% or 50% or 70%. I've just, some people like to buy all cash. They love the Dave Ramsey method, right? And you can not talk them out of it no matter what you do. Other people are going to leverage to the teeth. They're running at 95% debt to value ratios, right? So or loan to value ratio. So it just depends. It just depends. We just ask questions to help them think about it, but we don't give numbers like that.
It's very true.
Personally, I'm at like 30 to 40%. That's the equity that I would like to have going into a property. And I'm sure there's investors out there that are like, oh, I can't believe that you don't leverage up more, but that's just me personally.
It is true. Everybody's risk tolerance is very important. Their age, How much of your portfolio does this particular property represent? All of those things have to be handled in an overall. And where is the property? What's the level of the tenant? Is it an individual? Is it a type A client? All of those things have to be factored in to determine what your risk factor is. And it is. You've got Dave Ramsey on one side and Grant Cardone on the other, from a standpoint of thought process when it comes to debt. So you have to figure out where you fall in that scale.
Yeah, it's super interesting. And it's interesting how you've got some clients that are just paying all out cash versus those who will leverage right up. I guess there is no method that is the single best method. I guess it comes down to personal preference, but there's probably advice that you can provide to make sure people don't get into the
history is like 2020, right? Like it's so clear. I mean, a lot of our investors and clients that leveraged to the teeth over the past decade, what happened? Well, now they're super, super rich, right? Versus people that bought cash. I mean, they're still doing well, but they're not super, super rich. I mean, we know people that went from, portfolio of $500K to $30 million over the past decade just because they were constantly releveraging. Now they're at a point where it's like, well, I have this big portfolio with a lot of equity that doesn't cash flow very well. So that's a new problem, especially in this market that's now flat and the interest rates are going up. But debt, people that like debt did very well over the past decade. So yeah, I think it's just, it depends on a lot of factors. Sharon is great pointing out age, risk tolerance, where you're at in the market. You really got to consider all these things, but debt's not bad. It just, it carries more risk if the market goes down.
There's good debt and there's bad debt. So you want to make sure that your good debt doesn't turn into bad debt. All right. Bad debt, yes, like credit cards, but your good debt, it adds momentum to your money. So your money needs to be in constant motion. And when you have good debt and then you refinance, you're creating momentum into your portfolio.
And you mentioned just before about this whole idea of cash flow and appreciation. I think there's a lot of kind of real estate investors that will focus on one or the other. Why don't you give your advice, Sharon, about, I guess, that relationship between cash flow and appreciation? What's more important, or are they equally important? What should you be focusing on when it comes to kind of building a more profitable profitable rental portfolio, but expanding it as well?
Well, there are reasons to invest in both, right? So I own pieces of large community developments. There's no cash flow. It's a 10-year out play, but it's very much appreciation. So we can look at 500 to 1,000% increase in our investment, but we have to wait for it. And so that's totally an appreciation and growth, strategy. But cash flow is what allows you to build your personal wealth and maintain and increase your style of living. And so you look at both cash flow and appreciation when you want to invest in a property. So when I teach my basics on real estate investing, I go, it's the greatest leverage on earth. Let's say you put 20% down and the bank gives you 80%. So you've only had to put 20% down on, let's say it's $1 million property. You've put $200,000 down, but you own 100% of that $1 million property. You own 100% of the appreciation that property gets. You own 100% of the tax benefits from that. All right. So that leverage is fantastic. You only had to put $200,000 down, but you've got the appreciation, the depreciation, all the cash flow benefits from the $1 million property. And that's why real estate is so attractive. And that's why, the clients Brandon's talking about that went from $500,000 to 30 million over the last decade, they were able to continue ramping up that momentum of their money so that they could do that through the leverage of debt.
Yeah, super interesting. And I guess this kind of side segments into the next question for you, Brandon and Sharon, actually. What are those sort of numbers that you're checking most regularly, and how do you check them? What are the numbers that are most important to you on a day-to-day, month-to-month basis? How about you start, Brandon?
You just, like, in terms of managing my portfolio?
Just generally, what are the types of metrics and numbers that you'll be, following like a hawk, and the ones that you'd suggest to your clients as well?
So for me, it's I'm still trying to figure out what do I invest in and why. So Sharon's got a lot of good experience on me, so I can't wait to hear her answer. I have bought the properties that cash flow to keep the lights on, but in higher appreciating areas, and also the properties that there's no chance for appreciation except over the last like 3 years for just everything's blown up. But going into it, there's no chance for appreciation, but it's going to cash flow really well, and it's going to provide this nice income stream. So for me, I look at my bottom line cash flow number compared to my gross rents, and that percentage is just different based on the asset that I've bought and whatever the goal was for that asset that I bought. That's primarily what I look at. Now, I also look at, and I know there's a lot of investors, especially on the institutional side, that will probably agree with this or disagree with this. I'm sorry. What I also look at is my return on equity, because if you've held a property for 5 years, even if you've put no additional money into it, you have paid down that loan. And, I kind of think about it as a bank. So the cash flow that I'm now receiving compared to the total equity, what is that number and how does that change every single year? Is there a different place to park that equity, or is it good to continue leaving it in that property? When I have these conversations with people, sometimes they're like, oh, that's a made up number. It doesn't matter. But for me, it seems very real. So that's currently what I look at, whether it's right or wrong. Really just the percentage of cash flow that I get compared to gross rents, but that's a per property target that I'm setting, and just with different goals and expectations. And then it's that return on equity number and watching that go up or down based on rents and expense management. And then also based on appreciation. Right now my return on equity is like in the toilet because everything's gone up so much, but it's like, what do you do? If I sell one, I can't go buy another one for anything less. So you might as well leave it. You can't refinance because rates have skyrocketed too. So,
I would add, and I think all that is totally important from a perspective of the overall property. But I think it's really important as a real estate investor for you to understand the area as well, the community. So for instance, I live in Arizona. Arizona is a hot place to invest in right now because we have so many people moving into the state. Well, then I look at short-term rentals. People are investing in that, and it's getting flooded. And now we have a huge move where neighborhoods are starting to outlaw short-term rentals, and people bought properties based on the cash flow projected from a short-term rental, which you cannot get in a short-term rental. So we're seeing a lot of people going upside down because of that. And so you really have to understand what the average rents are. Is it still a growing market? Is it a hot location? Doing a short-term rental in Old Town Scottsdale makes a lot more sense than one way in the East Valley in Arizona. So again, you have to understand what's happening in the industry. So that's why it's important to be part of associations like Arizona Real Estate Investors Association. You probably have one wherever you live, so that you hear from those that are really involved in it at a very high level. When things are changing, you're there, you hear them talk about it, so you can make those adjustments. The other thing, and is condition of the property. One of the reasons we sold our apartment complexes in 2007 was I was looking at a lot of deferred maintenance. And I said, okay, I need to invest a lot of money. And we had paid down, we had a lot of equity in them already. And I thought, let's lever up, right? So we sold those properties, and before we could lever up, the market crashed. So it was a gift to us from heaven that we were out of that at that value. And so I think it's really important to understand conditions of the property, the monthly cash flow, the numbers, but also conditions of the market. And so that you are looking at every aspect that's going to impact the future appreciation as well as the current cash flow from the property.
Yeah, that's great advice. And it kind of segues really nicely into one of the last questions I had for both of you, actually, is if you could go back in time, what are some of the three things you'd tell your younger self? I'm sure you've got a lot of learnings, Sharon, but if you're going back to tell your younger self of even any kind of changes that you make or any advice, what would they be?
Well, I want to go last on this one because I have a very strange answer. So Brandon, you go for it.
You jump in,
buy
Brandon.
Bitcoin. I would tell myself to buy Bitcoin.
Dogecoin.
You could have bought it for like pennies on the dollar back in 2011 when I was in college. Yeah, what a missed opportunity. Anyway, I would probably say, I got into real estate really early. I bought my first property when I was 25. It was a 3-unit property before I bought a primary residence. I think that I think I did that right. I would probably say um, I would have wanted to work a little bit harder to acquire the next couple of properties. I mean, I bought that one. My next one, it wasn't like the next one I bought was a 3-unit property where I lived in it and rented out the other 2. So that was great. But then it was a couple years before I really picked up the next rental. So seeing the power of real estate investing, of what happens in an up market, seeing it across our portfolio of clients. I just wish I would have doubled down and tried to make more deals happen. I was like taking the slower approach of earn money at the job and invest that. And I still basically do that today. That's just the way that I do it because I don't have a whole lot of time to go and invest in building a portfolio. But with what I know now, I think that I could have doubled down on the real estate investing, and who knows, maybe I'd be a full-time real estate investor now and not a CPA firm owner.
Okay, so my answer is I get asked this question a lot, as I'm sure you can imagine. At my age, I could go back a long time to talk to the younger Sharon, but I am a very strong believer in positive thinking, and I wouldn't be who I am today if it weren't for all the positive things that happened to me in my life and all the learning opportunities. And there's a lot of shoulda, woulda, couldas that brings people down. It's a waste of time. We have tons of real estate opportunities today. They're not the same ones as last year or the year before, but you know what? That time is gone. So why spend the time fretting or lamenting over it? We're all where we are today because of the choices we made before today. So if we want something different, something better, something even, in a different industry, start making different choices today. And know that it doesn't matter what's happening to the economy, there are always opportunities in real estate. You just have to sharpen your pencil. You just have to be a little smarter. You have to have the right people on your team, work the numbers, understand the location, and don't try to be the expert on something that you've never done before. Find the experts and learn from them. And don't try to do short-term rentals, long-term rentals, Airbnbs, commercial property. Don't try to do everything at once. Become an expert at one area of real estate and hone your skills. Have the right team so that it goes initially, as we've said already, real estate investing is hands-on. You got to get in there and understand that. So it takes time and energy and effort. But you get to the point where you have the right team, you have the right management company, and so you're just checking your numbers. Then it becomes passive because you're not involved in it 20 to 30 hours a week. So you make that decision, but don't beat yourself up about not having invested when you were 20 because you can't change that. So just focus on what you can do today and start making different choices.
I love that. And it's great advice from both of you. And again, really appreciate having you both on here today. There's been some great wisdom and advice that we'll share with everyone in our audience. Yeah, it's been really valuable. Sharon and Brandon, where can we find you and what are you doing at the moment?
Well, I'm pretty easy to find. Yes, I'm SharonLechter.com. Sharon Lechter on all social media, Facebook. My professional page is author Sharon Lechter. But reach out to me. You can email me info@Sharon Lechter. Would be happy to support you. I do have a real estate investing course that's online. I'm happy to support anyone from a mentoring perspective as well. So reach out to me, SharonLechter.com, info@Sharon Lechter.
Amazing. And how about you, Brandon?
Yep. For me, you can contact us at www.therealestatecpa.com. You can poke around our website. We've got a podcast. We have a bunch of educational resources. You can click that Become a Client button and, explore that as well. But we do have a tax course, a couple tax courses on short-term rentals, investing in long-term rentals, all that type of stuff. But we focus just on the taxes. So we've had a lot of people go through those and give us really good reviews if you're interested in sort of the DIY education component.
So that brings us to the end of our 2-part conversation with the brilliant Sharon Lechter and Brandon Hall. If you liked this episode, give it a like, subscribe to our channel for episode 3 of the Profitable Rental Podcast. And in that one, we're going to be focusing on growing your portfolio with a guest who scaled to over 1,000 doors in just a few short years. That episode is coming very soon, so just stay tuned into our podcast for that. Give Landlord Studio a follow on all socials as well. Landlord Studio on all platforms, Instagram, Twitter, etc., where we share more tips, advice, and industry news on all things real estate. So you don't want to miss out on that. Stay tuned for that. And until next time, have a great week.